over our VA renovation point. It looks like we have a couple of MLB people here today. We have Vanessa Hernandez, one of our top senior account executives. We have Ashley Scarfy, also one of our senior account executives, and also my partner. I like to always just kind of point that out because it's important for everybody to know that their account executives are as well versed in the products as I am, the host. And so you feel confident that when you're talking to your account executive that they too know that the same information that's being relayed to you. So without further ado, I'm going to go ahead and share my screen. And in the meantime, Ashley's going to go ahead and put her information and my information in the chat. So if you have any questions after the webinar or anything, you can reach out to us. All right, so let's get started. VA renovation. VA renovation. Very similar to a VA loan. The only difference is the renovation piece. And I say that because a lot of people will ask certain things like, well, what's your DTI? What's your LTV? That kind of stuff. And from a credit standpoint, from a guideline standpoint for, the DTIs and LTVs, and do you need reserves? Do you not need reserves? It's no different than your standard VA loan. So the whole credit risk and the guts of the file, including how collateral is reviewed, it's standard. The only difference between the two loans are the fact that it's renovation, and there's that little added piece. Something that I wait a little bit in the meeting to go over, I'm going to address now since it's kind of good to piggyback. We do have a renovation concierge desk. So I'm telling you that the credit file is the same as any standard VA, and the only difference is the renovation piece. And the good news is we have a renovation concierge desk. So other than the bid that you're going to provide to us, we take care of the rest. We're going to take care of getting the disclosures out to the borrower, the disclosures out to the HUD consultant if one is needed. We're going to reach out to the contractor, get all the contractor paperwork from them, get the profile, everything. I can go on and all that stuff, but you don't have to worry about any of it. We call it something cute. We call it learn as you earn. So you will be kept in the loop. You'll be CC'd on emails. We'll reach out to you if there's anything going on, like maybe the contractor's not responsive. We'll always keep you in the loop. But we are handling that. And we do it free of service. We're not charging for that. You're a business partner of ours, and we want to help you. We want to help you get more business. And if you're focusing on the renovation loan that you submitted, you may not be as apt to submit another renovation loan because a lot of people do shy away from the product, thinking it's very cumbersome and time consuming. So we take off a lot of that time for you so you can focus on your other loans as well. In the webinar today, we're going to go over some stuff like eligibility. There are slides about the contractors and what's needed, and that's just for your information. Maybe you have a realtor business partner or you yourself want to do a webinar with your partners. So we do have all the information in here about the consultant and the contractor and what's needed. But again, that's stuff that we handle for you. So we put that in here just so you have it in case you're asked about that stuff. Oh, and one really important piece, this last bullet point here. MLB just put this program out 2 months ago. April 8th, we released this program. So, like any program a lender releases, if you've ever noticed as a broker, sometimes the guidelines are a little tight and then over time they loosen up. We don't have a substantial amount of overlays, but there are a couple, and I'll point them out through the webinar. And then at the end, we have one slide that goes into the overlay so you can see what is a VA guideline and what is an overlay. So what is a renovation? If you've ever done a renovation, let's say 203K or home style, a renovation is a single close and it enables the borrower to purchase a home that needs repairs or wants to do some upgrades. Of course, this is VA, so it's backed by government security, which is an added benefit. And this right here, this screen right here applies to most of your renovation products in terms of it's only for a purchase and rate and term refi. So you can't get any cash in addition to that or do debt consolidation. With VA, they don't have a rate and term product. They have cash out 1 and cash out 2. Your cash out 1 is your rate and term product, and your cash out 2 is your traditional cash out refinance. So the cash out 2 is the refinance that's not permitted for this product. Specific to VA, the repairs have to be permanently affixed to real property. So just to give you an idea what that means, if your structure is here, and separate to your structure, you want to, let's say, build a garage and it's not affixed to the property, that would be a type of repair or upgrade that you can't do. It would have to be an attached garage in that example. With VA, and this is lender I'm sorry, industry standard, you'll notice that there are some caps with what you can borrow or types of repairs you can do. It is industry standard and VA required that you can't do any major structural repairs. And as you see, as we go on, you'll see that the limitations on timing are a reason for that because they give you only so much time to do repairs. So if you're tearing down a home, chances are you won't be able to get all that work done within the limitations that VA sets for time frame, which is 4 months. So anything structural or major or full tear downs, that's not something VA does permit. And just to go into it, if anybody here is familiar with the FHA limited program, they have 2 programs and one is called limited. This is very similar to the FHA limited program. So you're limited on the amount you can borrow, you're limited on the type of repairs you can do. There's only so many draws. It's very, very similar to the FHA limited program. In this slide, it just goes over a couple of things that really why you would use a VA renovation. One big thing I see a lot with VA renovations are roof replacements, because that does fall within the limits of how much you can borrow, and it's also not major or structural. But if your family has outgrown your starter home and you want to maybe rearrange some of the room structures in the house to build another bedroom, you can do that. If you want to upgrade because it's an aged home, I like to always tell my audience about a loan we had not too long ago where the home was built in the early 1800s and it still had push button electricity. So you and I are accustomed to flipping a switch to turn it on, flipping a switch to turn it off. This electric was you push a button to turn it on, you push a button to turn it off. And of course, the borrower wanted to upgrade that, so they upgraded the entire electric system in the house. So it's things like that you can do. Some of the benefits of the VA renovation, and one of my favorite is community revitalization. We have a home sometimes in areas that are not really built up. And the more we can get this renovation product out to the public, the more we can help revitalize those communities, build them up, get them to where they need to be, get their values up, become a more desirable area. And there are some people that love the area, but the homes are just, not upgraded. So that is a great use for this program. Of course, just like regular VA loans, there's no down payment. You can go up to 100% financing. With your standard and renovation VA loans, there's no MI. So these are 2 very big benefits that separates itself from the FHA program and most of the Fannie Mae home style programs. Another common thing that we do see as a lender is a standard VA loan comes in. We're reviewing it as a standard VA loan. We get the appraisal, and the appraisal subject to some work. So it's very simple. In a case like that, we've done change of circumstances to flip it over to a renovation. And then, of course, we get the bid and we proceed as a renovation loan. So if you ever have that kind of situation, and that applies for your Fannie Mae and FHA as well. If you have a standard loan and then your appraisal comes up as subject to, and there's some work to be done, you always have the ability and option to do a change of circumstance and flip it over to a renovation. So eligible veterans. This right here is one of our overlays in terms of FICO score. Now, nobody on this call does work in the state of New York, but all other 49 states, we have a minimum FICO score of 600. So at this time, we're not allowing any loans to come in under 600, but that is a guideline. That is an overlay of ours. I'm sorry, not a guideline. It's an overlay of ours that over time you'll most likely start to see tweaked, allowing lower LT, what's wrong with me today? Lower FICO scores. But right now, as it stands, it is 600 minimum FICO score. And if you're doing a refi, if you like where you live and you just want to upgrade your home, your standard seasoning and VA net tangible benefits apply, just like any cash out one loan. And again, just to reiterate, just like a VA reno, a VA standard, your DTIs, your LTVs, the guidelines, for the exception of the renovation piece, it's all the same. So if you're familiar with your standard VA loans, then all you have to do is really understand and learn the renovation piece because they're the same. So this is where we get into the guts of what a VA renovation will allow. So at this time, there are no minimum rehab costs, okay? We have a loan right now. There is a garage with a hole in the roof. That is $1,500. That would qualify for a VA renovation. It's not major structural work. It's within the limitations of the VA cap 75,000. So we're flipping that over to a VA reno and we're going to fix the roof. And we didn't know about that, by the way, until we got the appraisal. So that's one of your examples of a loan that we flipped from a standard VA into a VA renovation. For VA renovation, your max rehab costs is $75,000. So I want to go into that a little bit, because if anybody here is familiar with FHA and renovation costs, when you talk about bid with any other product, or I'm sorry, the maximum renovation cost, that includes your bid, your contingency reserve, any inspections, post-closing inspections, things like that. VA is unique because your bid itself actually can be up to $75,000. And then in addition to that, you have your rehab costs, like your contingency reserve and all that. So that's a big difference between VA renovation and your other renovation products, that the bid itself can be the cap, and then all the costs are added on. Any repair, and by the way, to go back to the 75,000, that is an MLB overlay. However, you'll notice it's industry standard. There's no lender out there offering more than 75,000. That might be something we'd be willing to tweak to be, more competitive and gain a little bit more of that business. But at this time, we're keeping it as industry standard 75,000. Any repairs over 50,000 will require a HUD consultant. So from $50,001 to 75,000, you will need a HUD consultant. And yes, it's a HUD consultant. It is the same consultant list that you would access for FHA. And this right here, this next bullet point about identity or a conflict of interest, same as FHA and Fannie Mae. So any identity of interest or conflict of interest is not permitted between anyone within the transaction. So if the realtor is a contractor, doesn't matter. They can't perform the work. Of course, if the borrower is, they can't perform the work. If the seller is, they can't perform the work. I will also bear in mind that conflict of interest would also relate to family members. So if there's a brother, a father, that would also fall within the identity or conflict of interest. So unfortunately, this would have to be a situation where the work is done by an uninterested and unrelated third party. And I will tell you, I've done a lot of renovation loans. And, many times if you're looking at, just doing an upgrade, doing some small work, maybe just putting flooring in, and you and your neighbor want to do it, be careful. Be really careful hiring your local handyman or someone that does, just small work. They have to pass vetting. Every renovation has a vetting you have to do for a contractor. And the vetting consists of a contractor profile that the contractor fills out and provides to us. And they give us 3 or 4 references, people they've done work for. And if they are doing a $50,000 job on your loan, and they've only, changed light bulbs and maybe ripped up a carpet and really doesn't have a lot of reference, they most likely are not going to meet the vetting process. So it's better to just find a third-party unrelated contractor who's licensed and able to do the work and has performed similar type work as to what you have on your loan. On VA renovation, you have up to 3 draws. And each draw will require an inspection prior to the release of draw. So I'll give you an example. I always like to use the kitchen renovation scenario. So let's say you have a kitchen and you want to renovate it down and build the whole thing up. So step or phase 1 would be demolition, right? You're going to take the cabinets out. You're going to rip the flooring up. You're going to take the sink, whatever, rip it all out. That's phase 1. Once demolition is complete, an inspector goes out to the property, confirms debris is all removed and the demo's complete. We get the thumbs up and the first draw is released. And that is with any renovation product you have. The first draw is always released after the phase is complete. So now using this kitchen rehab as an example, once the demolition's done, we release the first draw. The next stage, let's say, would be installation of cabinets, installation of flooring, and then the inspector comes out, says the work is done. Second draw is released. And then your final draw maybe is plumbing, electric work, whatever, painting, and so forth. So you have up to 3 draws, 3 stages of work. And keep in mind, your cap is only 75,000, so you're really not going to need too many draws. And you'll notice as we go on a little bit further, with the limitations of VA, it's the type of work that you're permitted to do wouldn't require more than 3 draws anyway. Like if you think about the roof replacement, that's just 1 draw. It's 1 roof, you take it off, you replace it, and then you get your money. All work must be completed within 4 months. See, that's one of the main limitations that VA puts out there. You have 4 months to complete the work. You have to start it within 30 days of closing, and you only have up to 4 months to complete it. And if you have a HUD consultant, if you have work over 50,000, that HUD consultant's going to keep that work going, and make sure we meet that time frame. Which is why I always recommend, regardless of the amount, to get a HUD consultant. Many times the HUD consultant fee is financeable, and they'll allow it to be financed. Sometimes they want to be paid up front, and that's their right. But if you can finance the consultant fee, it's pennies out of pocket every month to have it financed, to have that support of the contractor, to make sure the work's being done in a workmanship-like manner, make sure the right materials are being used, and make sure the work is being done timely, because that's really the biggest piece. If for any reason you're reaching that fourth month, your only alternative is to reach out to the servicer that's holding your loan and request an extension. And if they don't grant you that extension, now you have an incomplete job. And now you're going to have to work with that servicer to either extend the work. And I can't even really go into what the options you would have at that point, because typically the servicer handles it, so that, we're not involved with that. But I really just like to impress upon the fact that 4 months, VA specifically, is very strict. I've seen FHA and conventional be a little lenient if you need to go beyond their timeframes, but VA's pretty strict. I skipped the second to last bullet point, contingency reserve. This is a big one. This is considered a rehab cost. Let's just say you are gutting out a bathroom. That's your work, right? So you have it inspected, you got a bid done by a contractor, you're going to tear some walls down, maybe expand that bathroom out a little bit. So you close the loan, now the work begins, and they rip that wall out, and there's a leaking pipe in the wall. Nobody could have foreseen that. But where's the money going to come from to fix that pipe? Luckily, there's a contingency reserve, and that's what that reserve is for. Unforeseen repairs that are needed, that were not accounted for during the process of getting your bid and inspections. So if you have a contingency reserve, they'll pull the money out for the repair of the pipe in that example. Any unused contingency reserve is put back as a principal reduction. It's not given back to the borrower in cash, because they don't permit cash going back to borrower. The reserve itself could be anywhere from 10 to 15%. It's 10% if the repairs do not require utilities to be shut down. But if you do require utilities to be shut down, like electric work, if you're doing electric work and you got to shut those utilities down, it's 15%. And that's because when you turn utilities off and turn them back on, you run the risk of something happening. I think we all may have been there when you shut water off and then, you got to burst the pipe. And so you have to make sure you have a reserve to account for that kind of unforeseen possibility. Before we go any further, does anybody have any questions? And I like to keep this very informal. So just unmute yourself, chime in, or if you're more comfortable, you can ask in the chat. Okay. This is a really, really important piece. And I'd like to just say this applies to any renovation loan. When you're performing a renovation loan, it's super important that you order the appraisal properly. I have seen some awful situations where the cost has doubled because it wasn't ordered properly, or you end up not meeting your closing date because of the delays with the appraisal because it wasn't ordered properly. So you just have to remember two key things. First and foremost, when you're ordering the appraisal, you have to have the bid. Even if you order it as a renovation appraisal, if you don't have the bid, that appraiser is going to do a standard appraisal report, because without the bid, they don't know what work you're doing. So they don't know how to make it a, dependent on repair type appraisal report. So you want to make sure you have the bid before you order that appraisal. And when you order that appraisal, you order it as a renovation appraisal report. I've seen some nightmare situations where it was ordered as a standard. The appraiser has to go back out to the house once you provide that bid to them. So now they charged double for the appraisal because that appraiser had to do it twice. And it took an extra 2 weeks to get the report. That loan in particular had double the appraisal costs and missed their closing date, all because the appraisal wasn't ordered properly. So be really, really careful about that. So this slide goes into some eligible repairs. And we did this because, because you're capped at 75,000 and VA says there's no structural or major repairs that any repairs that will require an architectural design or plans and specs, things like that are considered major structural. So they don't qualify. So we listed a whole slew of what is eligible. And you know, take note of it. I'm not going to read through all of this, but and you're going to get a copy of this slide, so you'll be able to really peruse it. But there is a lot you can do. I mean, you could do anything from, let's talk cosmetic, anything cosmetic within that $75,000 you can do. You can upgrade your home, upgrade your flooring, you can expand rooms out as long as you're not tearing down a load-bearing wall, because that would be considered major structural work. You can, you know, add space. I mean, you could do whatever you want to do within that $75,000 cap, and that will be completed within 4 months. If you do happen to have a job, that 75,000, it requires a HUD consultant, of course, and that HUD consultant sees that this is considered major or we're not going to meet the time frame, they're going to let us know. So this way, you know, we don't get to closing and then the borrower is surprised with work that is impossible to complete. So there's a lot of fail safes to prevent that from happening. You could do a lot of stuff. I mean, mold remediation, that's a safety issue, right? But you can do that. You could do safety issues with the VA renovation. You can install appliances. You can do siding or gutters. You can repair or replace plumbing, AC units, electrical systems. You can connect to public water. You could do so much stuff within the means of it not being major structural or a tear down. So here's a list of ineligible repairs. The list is not as big, but you'll notice it covers quite a bit, right? So one of them is any repair that prevents the borrower from occupying the property for more than 15 days during the renovation period. So this is saying that if during the renovation period, the borrower has to vacate the home because it's not habitable for more than 15 days, that's something that won't be permitted. So if you're going to, let's say, I don't know, let's say you intended to expand your house out. So now you got to tear a wall down. It's exposed to nature. You can't live in a house like that. That could take more than 15 days to fix and put back up. So, you know, again, the HUD consultant and the VA underwriter, you know, that's what they're there for. That's the fail safes I was referring to. They're there to make sure the work being done is permitted and within the guidelines. Of course, any repairs that will take more than 4 months, we talked about that. VA energy efficient, that is an overlay. You'll see that on our overlay sheet. There's a lot of moving parts with that, a lot of additional steps. And we would like to be part of that. So until we're in a position where we can help you with that, we're going to keep it on the back burner for now. But it is something that we're going to loosen up. Purchasing an existing structure on another site and moving it to a new foundation. That's very specific to manufactured homes. So if you have a manufactured home and you want to pick it up and move it to a different location, you can't do that. Matter of fact, we don't allow that on regular VA. So you can't do that on VA renovation. And any repairs or installation of waste management like lagoons, cesspool pits. The reason for that, you can do that with an oil tank. You can do, not an oil tank, a well. You can do other things, but specifically the private waste management systems, they require different permits and stuff from town. And those things take time. You know, some areas you can get it done in a few weeks. Some areas like New York, Texas, Florida, they could take months. So unfortunately, that type of repair, you have to be cautious for. So we put that on the ineligible list. So far, any questions on VA renovation product or eligible, ineligible repairs? Maybe someone has a scenario they want to just run by. Like I said, please just unmute yourself. So this slide goes into how to calculate your loan amount. And this is no different. It's worded a little differently, but it is no different than any other renovation loan. So I'm going to sum it up for you. And then when you get the PowerPoint, you can see the way it's worded. But really, realistically, in order to calculate your loan amount, and we'll use purchase as an example, you're going to take your purchase price, you're going to take your bid, all the repair costs, jumble it all up into one number, and that's your loan amount, right? Because you could do 100% financing. But be cautious, because if the appraisal comes in lower than all of that, we have to lend on the lower of the two, just like any other loan, right? So roof repair is one to keep in mind. A roof replacement, and not repair, replacement. You don't get dollar for dollar on your roof. So if you do a $20,000 roof, you're not increasing value by $20,000. So when you're doing 100% financing, you want to be cautious, because if that appraisal comes in less, then we can only lend on less, which means they're going to come out of pocket for some of that repair. But if you're going to do upgrades to kitchen, like change, you know, your standard cabinets to, you know, more upgraded cabinets, maybe put in marble countertops, this does give value. Wood flooring versus carpeting, that does give value, and that'll help you meet more of being able to lend on all of the money that you're looking for. So again, it's the lesser of the appraised value or purchase price plus all your repairs and repair costs. On a refinance, it's your mortgage payoff plus all repairs and repair costs. Same, the lesser of that or the appraisal. So, if you're unsure about it, I guess you can do a Zillow or an estimate to see like what the value is going for at that time. And then you can decipher whether or not you're going to be good by taking your purchase price and your bid and repair costs and add it all up. Of course, you can always readjust your bid and your loan amounts throughout the loan process. So if there's some extras in there that the borrower is willing to chip away to bring it down, you can do that. But we want to try to maximize the borrower on what they want. So just keep in mind, it's the lesser of the two. So here's just an example or two examples of when you would use the appraisal if it came in less, or you're good because the appraisal came in high enough. So in these two examples, the first example, it's a purchase. We have a contract of sale for $100,000. The bid is $75,000. It has a 10% contingency reserve, which is $7,500. There is one inspection fee for $250, one permit fee for $250. So that totals $183,000. So that would be our loan amount, right? At 100% financing. But the appraisal came in at $180,000. The appraisal came in $3,000 less. So that's the money the borrower has to bring to closing, right? That kind of defeats the purpose of doing 100% financing when you're coming out of pocket for some of this repair. So this is why I say, it could happen, but I will tell you, I'm an underwriter. I have underwritten these loans. I've underwritten FHA and Homestyle. It doesn't happen that often. I'm not going to say most of the time you're not going to get value or half the time. It's very infrequent, but because I've seen it, I like to really impress upon the fact that it could happen. An example number two, we have the same cost. You have your contract price of $100,000, your alterations, contingency reserve, inspection, and permit. They all add up to $183,000, and the appraisal came in at $190,000 in this example. Now we can give you the full $183,000 because the value came in higher. I mean, really, this is just standard 101 type, understanding of taking the lesser of the two. But this has got that little nuance or a caveat of, the repairs and all the costs. So if you were just doing your contract price of $100,000, your value would most likely be $100,000. It's when you're adding in all these repairs, hoping that the after improved value is going to factor those repairs in and maximize the value that you need. And that, by the way, again, is any renovation product. That's not just VA renovation. This is one of those slides that we put in here that you do not have to worry about. These are the items we're going to ask of the contractor. So, other than the first item, because you're going to provide the bid to us. Once you give us the bid, everything else our concierge desk is going to take care of. And I want to repeat for those who came in here a little bit late, we have a concierge desk. We handle 95% of the renovation work at no cost. We're not going to charge you for it. You're our business partner. We want to help you with your business, not just the loan. You have other loans to worry about. So we take on 95% of that renovation work. All you have to do is give us the bid, and then we contact the contractor to get the driver's license, profile, and all the other good stuff. So I'm not going to spend too much time on this because we take care of it. But like I said, those who are here late, you will get a copy of this PowerPoint if you want to present it to your realtors or you want to put something together so you can see what do we take care of. And sometimes you will be asked, to get some stuff up front, like you want to prepare the contractor. So you'll have that list of what we'll be asking of the contractor. So this is our overlay sheet. And as much as no lender wants to highlight overlays, this being a fairly new product, we really did want to make sure you had an understanding of VA renovation, but also what are the overlays? And like I said at the beginning of the meeting, this is a new product for us. So over time, you're going to see us tweak it a little bit and get a little looser on some of these overlays. But right now, this is, the way we have it right now. One that's not listed here because it had its own separate slide, just for those who didn't see it. Our minimum FICO score in all 50 states is 600. So right now, that's one of those overlays that we're probably going to tweak over time as the product gets more out there. But right now, it's 600. Nobody cares about this on this call, but we don't do loans in New York because I know nobody on the call works in New York. Unlike regular VA loans, if you have a borrower with no FICO scores, you can't do that for VA renovation. I get nervous with this sheet right here because it's specific to VA. A lot of these overlays do not apply to our standard VA product. So on our standard VA product, our minimum FICO score is lower than 600. And I don't want to say it to confuse everybody, but we do permit in New York. We do allow more than single family residents. We do allow more than fixed rate. So this is all specific solely to VA renovation. Keep that in mind so you don't get that confused. If you do have a borrower with no FICO score, you can do that on your standard VA, just not on the renovation. Joint loans, that's something we do see, not too often, but sometimes. So joint loans, we do allow on your standard VA. And just in case, for those who do not know what that is, a joint loan is when you have a veteran as borrower number one, and borrower number two is not a spouse and not a veteran. So, let's say, Rudy, let's say you and your cousin want to buy a home together, and your cousin's not a veteran. That's considered a joint loan. Those types of loans, by the way, have to be sent to VA and reviewed by the VA once all our conditions are met. But that is not permitted on VA Reno. It is permitted on our standard VA. Any luxury recreational repairs are not permitted. I'm not quite sure why this is on our overlay sheet, because this really is industry standard, although VA allows it. You're not going to find anywhere in the industry that allows any structural repairs that requires an engineer report, specs, plans, or architectural reports. Because again, remember, you have that 4-month time frame, and that type of work that you're looking at with architectural repair specs are going to take longer than 4 months in many cases. So we have no minimum rehab costs, and your max rehab is $75,000. And like I said, although $75,000 is our overlay, that is industry standard, $75,000. Any repair over $50,000 does require a HUD consultant. That is our overlay. And you will find lenders that have that requirement, but not everybody has that requirement. We have that requirement because anything over $50,000, we really do feel that a HUD consultant should be there to oversee the project, make sure the work is being done in a workmanship-like manner, all the materials that the borrower paid for are properly being used, and it gets done within the time frame of the 4 months that VA has. Loans cannot close in a trust. The home must be habitable at the time of application. So when you're taking technically time of application is when you submit the loan to the lender. So when you submit the loan, the house can't be under repair. Now I'll give you an example. There are many times we are approached with a scenario where a house was under construction, and I guess either they ran out of money to finish the project. So they call us and say, hey, could we do a renovation loan to finish the project? My answer is yes, you can, as long as you have a certificate of occupancy. If a CO has been issued and you have a partially completed project, we can complete it for you. If it's a brand new construction and a CO hasn't been issued, that's considered more of a construction loan, which is not renovation. So that we can do for FHA and Fannie Mae, but not for VA. If the home is not habitable or under construction when you take that application, VA renovation is not your product. But FHA renovation, you can go that route. If the borrower really needs a renovation product, you can go the FHA route as long as you have a CO. And last but not least, no release of funds at closing for draws or prepaid materials. You'll notice it's awfully specific the way they wrote it, because other renovation products allow that. Other renovation products allow you to be reimbursed up to 50% of prepaid materials at the closing table. And that's very helpful when you know you're not getting your draw until the first stage is complete. Getting 50% of prepaid materials helps that first stage out. That is not permitted on the VA renovation product. But again, if this is something that's absolutely important and it's going to make or break the borrower getting that home, we can always offer the FHA product, which is, of course, 96.5% financing for purchase and 97.75 for refi.
I got a question.
Absolutely.
What if a veteran is wanting to buy a property from a relative that needs some renovation? An older relative, younger veteran, is that allowed, or is there an issue because of the family relationship? A grandfather,
No.
grandson. Okay.
Okay, so that's really good question, Rodney. And again, those who popped on a little bit later, there was something under, and I'll bring up that. So I assume this is what you're referring to, Rodney. Hold on, right here. This identity or conflict of interest not permitted. That is specific to the renovation. So that's specific to the contractor you're using, or other parties to the renovation piece. If you're buying from a family member, that's fine, because that's a guideline. Like your DTIs, your LTVs, your standard guidelines, that's okay. This is specific to the renovation. So yes, in your example, you could have that. You can have a
Okay.
borrower purchase from a family member and then do a renovation loan. And that's for any product, by the way.
Okay. Thank you.
Of course.
Question, Andrea, are the limitations to seller credits when it's arm's length like that?
No, with VA renovation is no different than your VA standard. So your seller credit guidelines are going to be no different.
Cool. Thank you.
Any other questions? Okay, so what I normally do is once I finish with the webinar, I like to bring up our website because this is a very rare product. And I don't know about you, but when I have a product that I can offer to you guys as my business partners, I capitalize on that. I do. And how do I do that? I'm going to do drip campaigns. I'm going to go on social media. I'm going to do all this marketing stuff. I'm going to call you guys. So I want to show you where to go to get this flyer. This is a very unique flyer. And I'm going to do something so different after doing this, and I never do it because I saw somebody pop on and I think it's important. Maybe he could talk to you for a few minutes. And he has no idea I'm going to call on him. So I'm going to put him on the spot. So if you want VA marketing materials, you would go to resources. So I'm sorry, mlbwholesale.com, go to resources and go to marketing materials. In here, we have an array of different materials. And I don't know if you can see it here. Let me see if I can maximize this a little bit for you. The first two that pop up are our renovation concierge desk right here. And then our VA renovation web flyer. So we can personalize these flyers, put your DigiCard on it, your information. Like, we're not highlighting MLB wholesale with the flyers. We're highlighting you. We want you to use it for your business. So if you do want, and you'll see there's also 203K in here, other types of, loan products. We also have down here our non-QM flyers. So any flyers that you do want, you'll notice each flyer has a number corresponding to it. Some have numbers and letters. This is 20B because that's because we have a 20 already. But any flyers you want specialized to you, just call your account executive. Excuse me. If you don't know who that is, my information and my partner Ashley's information is in the chat. You just reach out to us. We'll get you in touch with your AE and also with marketing. So you would just give your account executive the number of the flyers that you want. Maybe you want a few. Just tell them which numbers, and then within a day or two, we'll have those flyers prepped and made for you. So you can put them at open houses, or if you're doing your own little webinar, you can hand them out to people, and you have your own personal flyers. One other highlight I want to make, I'm going to go back to the main page. So when you first log in, this is what the page looks like. We run daily specials right up here in the right-hand corner. And coincidentally today, and it wasn't planned that way, but today we have a daily special. I see that we did this yesterday, the same special. But for VA loans, FICO score over 660, we're giving additional 15 basis points. So if you do have any VA rehab, VA regular, and the FICO is over 660, you'll get an additional 15 basis points when you lock the loan. I'm going to stop sharing my screen for a moment. I want to just open this up to see if anybody else has any questions before I do something so unusual that I hope this person's not going to be upset. But it's important enough that you hear this information because it's not related to VA. He just looked up. Okay.
I
Go
had
ahead.
a question.
Sure.
And I may have missed it at the beginning. I apologize. When it comes to choosing a contractor, can they self-contract?
No, unfortunately, and this goes with all of our renovation products, they can't be their own contractor. But in
Okay.
addition to that, they can't, anybody in the transaction, such as buyer, seller, realtor, anybody in that transaction cannot be contractor. Another
Okay.
thing you want to be very careful of, Angela, is if your borrower's brother is a contractor, that's also considered a conflict. So the brother would not be able to do it either. So I really highly recommend using just a third party, unrelated person. I mean, I know it's tough because if you're doing minor stuff like throwing a floor in or something, maybe, they can do it. But, with this particular product, they do get a little bit strict on that.
Okay. I asked because I do have someone that was looking to purchase like a fixer-upper, but they are in the business of a contractor. So that was one of their reasons for wanting to do the same for their own home. But this would be
Angela, I have an idea.
Sure.
Why don't do you see my contact information in the chat?
Yes.
Okay, do me a favor. After this meeting, give me a call because I have an idea. It may not work, but it's an idea that may help you.
Okay,
Cool.
all right, thank you.
Any other questions before I deviate and veer away from VA? Again, I never do this, but it's something that I'm excited about it, so I thought it'd be helpful to share. Okay, so halfway through the meeting, our senior specialist for non-QM, which is such a treat to have. Oh, he's looking for him. It's such a treat to have because this man is constantly working. If you have never talked to Paul Sashariba, then you're missing out. He deals with all of our non-QM stuff. He actually does on the LOS some, I think Rodney knows Paul because he's about to say something, but so he does all of our non-QM products. So like me, myself, or Vanessa, or Ashley, we handle agency. Paul handles non-QM. And I know non-QM has nothing to do with renovation, but we have something called mix and match. And that was kind of what I was hoping Paul can share because it's kind of unique. And I'm getting a lot of whispers about it. So I figured I have a group of people here. Why not share it?
Yeah.
Yours, Paul.
Thank you, Andrea. Quite the lead up there. I got to live up to something now. Can you pull the PowerPoint back up for me? That'll help us out.
The
yes, I am
VA
Paul Sashariba.
renovation PowerPoint.
I thought marketing combined one for us. I'm sorry.
Gotcha. Okay. I see everyone. I told you, I put him on the spot. We are not prepared for this.
Yes, but that's okay. I helped write the guidelines, so I kind of know a little bit about the product. MLB mix and match is a phenomenal opportunity. It kind of takes the best of the non-QM income types and it lets you combine. This is what makes it really unique. I can combine all non-QM income types on one borrower for one loan when appropriate based on the income. That's a lot more flexibility than I see anywhere else in the market. That means you can have a borrower that's a W-2 employee, but they drive DoorDash, Uber, whatever on the side. We can add that in. Their spouse can be a P&L on top of that, and we can use asset depletion, make that all work together on one loan to get it closed. So it lets us get really creative with a lot of the borrowers we see today that have multiple income streams. We have a guy right now, for example, actually one of Andrea's brokers. The guy owns 5 businesses. The wife owns 2 businesses. We're using 4 of the 5 businesses, 2 of them on P&L, 3 of the other businesses, including the wife's, are on bank statements. We're depleting assets, and we're using rents from the subject property to qualify. So when we talk about income flexibility and calculation, yes, as we add all these income components, the loan's getting more complicated. You're going to need some help. That's what I'm here for. But that's the way to get some of these loans done that would no other way get done, because you got to show that varying income from the client. Mm-hmm. We can do a lot of this stuff down to 640 with the exception of P&L. And we can do a lot of this stuff up to 85, soon to be 90 LTV. Right now, I'll look at 90 LTV as well on an exception basis. But it's got to be a strong file. I got to have a 720 plus score to even entertain 90. Because 100% of the risk in the non-QM space is carried on that equity stance and in the interest rate. There is no MI to help protect us to lower that rate. Things to consider as well. You got to have some reserves in the space. You got to have 3 to 6 months reserves on most properties in the non-QM space to do this kind of income blending. But where we see the income blending really stand out is if you get a conventional file, you send it in, Andrea's working on it, something comes up, your income tanks. You can't qualify with that income, but you got somebody with a little bit of cash. That asset utilization we have will deplete the assets on as small of a timeline as 36 months. So if you think of somebody who's a W-2 employee, you can't get that DTI down. You're under 60, but you can't get down to an approvable DTI. They have a $100,000 401k. I can use 60% of the balance of that 401k. So $60,000, deplete that over 36 months. That gives you another almost $1,700 a month in income to use to get them down to that 55% DTI, which is our max qualifying DTI. So if you've got borrowers with a little bit of cash that just barely don't qualify, we got an option for you. If you need to do a cash out refinance for somebody, you can't meet Fannie's 12-month seasoning rule. Seasoning rules on my side are only 6 months. So I can get that cash out for you faster on a primary residence. One of the really exciting things we have coming coming early July. I don't have it yet, but it's coming in the beginning of July as a fixed term second mortgage that'll be qualifiable with all non-QM income types, including DSCR. So you're going to have the ability to do a DSCR fixed rate second mortgage as well. So lots of exciting stuff coming. Actually, last week we launched Premium DSCR. It's a DSCR product built for experienced investors and priced better because of that. We've maintained a ton of flexibility with our core DSCR product, where you can go first-time homebuyer, first-time investor, 85 LTV. So we've got options for the entire spectrum of those DSCR borrowers nowadays. So plenty of options coming out in the non-QM space. The mix and match can be done on anything except for DSCR. That's the only type of income we cannot blend, but it's a phenomenal way to make some files work that may not otherwise work. The real key there is bring me in ahead of time, bring in the coach. Let's disclose the scenario. Let's talk about it. Let's figure out, okay, we're going to throw this business out. We're going to use this business. We're going to use this asset. Because the best way to do a non-QM loan is to get it structured and packaged correctly from the beginning. The more we do that up front, the better experience you're going to have through the whole process. Because you got to remember, DSCR, well, non-QM in general, is 100% manual underwrite 100% of the time. So I've got an underwriter we can talk to about a story. I've got an underwriter we can walk through a scenario. But we've got to present the right scenario to get them on board to say yes. Because it's all manual underwrite. There is no AUS on that side. So let me help you. Lean on me.
Yeah, I just wanted to point out all these materials that I'm sifting through while Paul's talking.
Yeah.
Again, you can personalize these. DigiCard, we'll get them over. Reach out to your account executive. This kind of stuff. Paul is constantly picking up the phone, as Rodney will, if he wants to share a cameo. But he will sit there and work with you on your bank statements, help calculate income, and if he can't do it, he'll have the processor take a look at it. It's better to kind of have it looked at before submitted to make sure that it's a viable loan. And I know this was VA renovation, but I felt it was important because we have that mix and match program and so many exciting things going on in the non-QM space that it was important enough to at least highlight a little bit of it, so you knew about it.
And
Okay, I got a
this
question.
flyer brings up. Oh, go ahead, Rodney.
This is unrelated to what we talked about the other day, Paul. I have another potential applicant. He is a bonded contractor. He wants to purchase a home as his residence, but he's wanting to purchase a home that has not been completed, and he wants to do the completion himself. How can he's not asking for money he's not asking for money to do the completion. He just wants to buy basically the shell with the foundation and all of that, and he wants to complete it on his own time. Is there any
I can't have it
product
subject to appraisal.
subject to appraisal?
I cannot have a subject to appraisal. So the home's got to be habitable. And that's the issue he's going to run into.
Okay.
Yeah, and there's no agency product for that either. Yeah. That's tough.
Okay. All right.
But the flyer Andrea had up brings up one other great piece of flexibility in the non-QM space. What we do is we actually go by the credit score for the primary income earner, not the lowest of the two borrowers. So you see co-borrowers down to 540, right? We've got a deal going right now. Dad is a retired DA, makes phenomenal money, is a non-occupying co-borrower, right? Really important piece there. Dad's not going to live in the house. Daughter's the primary occupant, living in the house. Daughter's credit score is a 563. We're doing that loan at an 85 LTV based on dad's 789 credit score. Ignoring the daughter's credit, she's just there for occupancy. She makes no money, brings nothing to the table besides the fact she's going to live in the house. So phenomenal amount of flexibility to get deals done there. Does anybody else have any questions?
Any questions via Reno, non-QM, conventional? Let's just make this a mix and match of products.
Religion, politics. No, I'm just kidding.
Those are the ineligible topics that we can talk about today. Ineligible topics, politics and religion. All right, cool. I mean, everyone, thank you. Everybody stayed for that. So, you know, I know a lot of people do non-QM and like I said, a lot of exciting stuff happening. We have a possible new HELOAN coming in a month or so. And we're just expanding non-QM along with our products, such as the VA renovation. It's a new product. So, you know, the more we get them, we'll be reaching out to everybody and doing more of these one-on-one meetings through the LOS. So if you need anything, just give us a call your AE. If you don't know who that is, just reach out to me or Ashley and we'll get you, you know, you and your AE together and let's make it happen. Thank
And
you,
no matter
everyone.
who your AE is, give me a
Thank you.
call on the non-QM stuff. My cell phone number's in the chat, guys.
Thank you, Paul.
Thanks, Paul.
Yes.
Thank you, everyone.
Thank you, everyone.
All right.
Bye.